Welcome back, investors. Today, we're venturing into the creme de la creme of European markets, dissecting the financial performances of four heavyweight companies: ASML Holding, LVMH Moët Hennessy, L'Oréal, and SAP. These giants span sectors from cutting-edge semiconductor technology to luxury goods and software solutions. If you're an investor eyeing European stocks, this video is a must-watch. Let's kick things off with one of the most popular valuation metrics: price-to-earnings ratios. These numbers give us a snapshot of what investors are willing to pay for each euro of earnings. ASML boasts a trailing P/E of 38.54, slightly below its 5-year average of 43.51, indicating potential value in a high-growth industry. Its forward P/E of 29.17 suggests earnings are expected to keep pace with growth. Next, let's dive into the P/G ratio, which evaluates valuation relative to growth potential. A P/G below 1 indicates undervaluation, while a higher number can reflect a premium for expected growth. In this case, ASML boasts a 2.23, balancing high growth with a justified valuation. Continuing with LVMH, the titan of luxury, has a trailing P/E of 22.57, below its 5-year average of 31.45, reflecting a market reassessment or stable growth ahead. Its forward P/E of 21.61 shows measured optimism. However, its P/G is a little bit higher with a number of 2.45. L'Oréal presents a trailing P/E of 28.42, also under its 5-year average of 39.91, signaling fair valuation. Its forward P/E of 26.49 aligns with expected earnings stabilization. And a P/G ratio of 2.65 can indicate that investors are paying a premium. Finally, SAP, a leader in enterprise software, posts a sky-high trailing P/E of 104.20, well above its 5-year average of 40.24, reflecting extraordinary growth expectations. Its forward P/E of 41.25 suggests the market expects continued but normalized growth. Unfortunately, the high price-to-earnings ratio affects its high 9.20 P/G ratio. Now, a vital metric, insider ownership, a clear signal of management's confidence. Here, ASML lags at 0.75%, typical for such a large company. LVMH leads with a massive 49.33%, and L'Oréal follows with 56.61%, showcasing strong alignment between management and shareholders. SAP rounds out at 15.45%, reflecting solid confidence. Shifting gears to profitability metrics. ASML dominates with a return of equity of 49.22% and a return of assets of 17.47%, reflecting robust profitability from its innovative technologies. Its return of invested capital of 19.48% underlines excellent capital efficiency. LVMH shines with a return of equity of 25.44%, return of assets of 10.9%, and return of invested capital of 14.41%, showcasing its premium pricing power, but slightly below ASML one's. Continuing with L'Oréal, that holds strong with a return of equity of 21.98%, return of assets of 12.53%, and return of invested capital of 15.7%, cementing its brand-driven profitability. Finally, SAP, while less impressive, manages a return of equity of 6.48%, return of assets of 3.99%, and return of invested capital of 8.45%, reflecting steady operational returns. When it comes to earnings per share or EPS and growth, ASML's EPS of €17.61 is projected to grow at a 17.3% compound annual growth rate over the next 5 years, supported by a 23.38% compound annual growth rate in the past 5 years. In contrast, LVMH posts an EPS of €27.94, with a more measured growth of 9.19% compound annual growth rate for the next 5 years, while over the past 5 it increased by 14.41%. L'Oréal delivers an EPS of €12.11, growing at a 10.73% compound annual growth rate, also supported by 12.57% growth during the last 5 years. Finally, SAP achieves an EPS of €5.26, with a promising growth of 11.33% compound annual growth rate, consistent with its 13.6% in recent years. Free cash flow per share is a key indicator of a company's ability to generate cash after capital expenditures. SAP once again leads the way with a free cash flow per share growth of 21.58% over the last 5 years. The other three are far behind, with around 4% free cash flow growth rates. However, looking at free cash flow yield, here LVMH offers a 3.36% yield, very close to L'Oréal 3.3%. For dividend-focused investors, these companies offer varying yields and growth rates. ASML provides the lowest dividend yield of 0.92% with quarterly payouts between €1.50 and €1.75, growing dividends at a 26.18% compound annual growth rate over the last decade. LVMH offers a higher 2.06% yield with semi-annual payments of €5.50 and €7.50, but a more modest 15.23% in dividend growth. L'Oréal has a 1.92% yield with annual payout of €6.60, supported by a 10.19% compound annual growth rate. SAP offers a 0.91% yield with €2.20 annual payout and an 8.2% compound annual growth rate in dividend growth. Profitability ratios like operating margins and profit margins reveal operational efficiency. ASML leads with a 30.72% operating margin and a 26.41% profit margin. LVMH follows with 26.46% and 17.64%, respectively, reflecting its premium brand value. L'Oréal delivers 19.77% and 15.02%, showcasing steady profitability. Finally, SAP, at 23.59% and 8.25%, balances its margins in a competitive tech landscape. When we look at the evolution of revenue and earnings over the last 8 years, all four companies show strong growth, but there are some key differences. ASML has seen very positive revenue and earnings growth, which has been reflected in its market price outperforming the benchmark. SAP has also shown more flat growth, although its market performance has been more in line with the broader market. LVMH and L'Oréal have both seen positive revenue and earnings growth, but their stock prices have underperformed compared to the broader market over the last 5 years. Debt is key to assessing financial stability. ASML leads with low debt/EBITDA at 0.51 and debt/free cash flow at 1.63. LVMH and L'Oréal manage moderate leverage, while SAP shows higher ratios of 1.41 and 1.25, reflecting its growth investments. When looking at stock price performance over the last 52 weeks, LVMH and L'Oréal have both delivered negative returns of -12.27% and -22.16%, respectively, underperforming the market. ASML posted a solid return of 5.01%, despite the huge drop in the last months, while SAP overperformed with a 64.47% return. Now let's look at the market caps. LVMH is the largest company with a market cap of €315.20 billion, followed by SAP at €283.14 billion, ASML at €268.31 billion, and L'Oréal at €185.53 billion. Now, let's talk about the crystal ball moment, analyst expectations and fair values. Analysts have set varying price targets for these companies over the next 12 months. ASML has a price target of €844.42, representing an upside of 24.62% from its current price of €677.60. My fair value estimates tell a very different story. For me, ASML is close to its fair value at €685.17, suggesting it is fair valued right now. Continuing with LVMH's price target is €695.23, which actually represents an upside of 10.28% from its current price of €630.40, indicating that analysts see the stock as potentially undervalued. And for me, LVMH, with a fair value of €711.82, appears currently undervalued too. Now, L'Oréal has a price target of €404.36, with an upside of 17.68% from the current €343.60. And for me, with a fair value of €340.92 can indicate a fair valuation of this company. Finally, SAP's price target is €228.65, representing a downside of 5.51% from its current €242, with a fair value for me of €196.13, which is far from the current price and can also indicate an overvaluation. These valuations indicate that while there is some potential for growth, investors should tread carefully and consider these stocks' current pricing relative to their intrinsic values. So, whether you're drawn to ASML's innovative tech, LVMH's luxury dominance, L'Oréal's brand strength, or SAP's software expertise, there's something for everyone in these European giants. Remember, align your investments with your goals, and as always, do your own research. If you enjoyed this breakdown, don't forget to like, subscribe, and hit the notification bell for more insights into the financial markets. Until next time, happy investing!